You've probably heard about the 4% rule. Save $1 million, withdraw 4% a year, that's $40,000, and your money lasts 30 years. Simple, right? Well, here's the thing. That rule was created in 1994 using data that ended in 1993. And since then, everything has changed. Markets look different. You're probably going to live longer. And taxes? They're still very much a thing. So if you're planning to retire soon and you're counting on that 4% rule to carry you through, we need to talk. Because what worked for your parents might leave you running out of money at 85. Today, I'm going to show you what actually works now. And it might be better than you think. Welcome back to Simple Money Method. I'm here to help you make smarter financial decisions without the jargon or the fear. And today's topic is one of the most important if you're anywhere near retirement: safe withdrawal rates. The 4% rule has been the gold standard for retirement planning for 3 decades. Financial advisors have built entire practices around it. But in the last few years, major research institutions like Morningstar and Vanguard have been quietly updating their recommendations. And spoiler alert, they're not saying 4% anymore. Now, before you panic, let me be clear. Your retirement isn't doomed. In fact, some strategies today actually let you withdraw more than 4% safely, but you need to understand what's changed, why it matters, and most importantly, what you should do instead. So let's break this down step by step, starting with what the 4% rule actually was. Let's go back to 1994. A financial advisor named William Bengen wanted to answer one question. How much can you safely withdraw from your retirement portfolio every year without running out of money? He analyzed nearly 70 years of stock and bond returns from 1926 to 1993 and tested thousands of different 30-year retirement periods. His finding: if you withdrew 4% of your portfolio in year 1, then adjusted that amount annually for inflation, your money lasted through every single historical period. Here's an example. You retire with $1 million. Year 1, you withdraw 4%, $40,000. Next year, inflation is 3%. So, you withdraw $41,200. You keep doing that every year. According to Bengen's research, that worked 100% of the time historically. His model was simple: 50% stocks, 50% bonds, a 30-year retirement, and critically, it ignored taxes and investment fees. For decades, this rule worked beautifully. It gave retirees clarity, and financial advisors loved it because it was easy to explain. But here's the problem. His data ended in 1993. It doesn't include the dot-com crash, 2008, the pandemic, or today's market conditions. And when researchers updated the analysis with current data, they found something concerning. 4% might not be as safe anymore. So what changed? Why are experts rethinking this now? First, stock valuations. There's a metric called the CAPE ratio, cyclically adjusted price to earnings, that measures how expensive stocks are relative to earnings. Historically, it's averaged around 19. Today, it's at 40. Stocks are more than twice as expensive as normal, and there's a well-documented relationship. When stocks are expensive, future returns tend to be lower. That directly impacts how much you can safely withdraw. Second, bond yields. From 1960 to 1991, bonds yielded an average of 7.6% per year. Today, around 4.1%. When bonds yield less, your overall portfolio returns less, leaving you with less cushion for withdrawals. Third, sequence of returns risk. This sounds complicated, but it's simple and crucial. Imagine 2 people who both retire with $1 million and earn the same average return over 30 years. But person A gets great returns early, while person B gets terrible returns in the first 5 years. Even with identical average returns, person A could end with $1.2 million, while person B ends with only $500,000. That's a $700,000 difference, all because of timing. When you're withdrawing money, bad returns early in retirement force you to sell more shares when prices are low. Those shares can't participate in the recovery. With today's high valuations, if the market drops 20% in your first couple years of retirement, you're locking in that sequence risk. Finally, taxes and fees. Bengen's research ignored both. Most people pay 0.5% to 1% annually in investment fees, plus 15% to 37% in taxes depending on their bracket. Factor those in, and your real withdrawal rate isn't 4%, it's closer to 2.5% to 3%. Add it all up, expensive stocks, lower bond yields, sequence risk, taxes, and fees, and researchers started asking, is 4% still safe? In 2025, Morningstar updated their recommendation to 3.7% on a $1 million portfolio that's $40,000 versus $37,000. That may seem small, but over a 30-year retirement, that's $90,000 lost. Here's the good news. You have options, and some might actually let you withdraw more than 4% safely. The conservative baseline. If you want maximum safety and won't adjust your spending, Morningstar says 3.7% for a traditional 50-50 portfolio gives you a 90% chance of success over 30 years. But here's where it gets better. If you're willing to be flexible, spending less in bad years and more in good years, you can start at 4.5% to 5% and still maintain long-term portfolio health. This is called the Guardrails method. You set upper and lower limits for your withdrawal rate. Start at 4% with guardrails at 3.2% and 4.8%. Every year, recalculate based on your portfolio value. If your rate drops below 3.2%, your portfolio grew, you can increase spending by 10%. If it rises above 4.8%, your portfolio declined. Cut spending by 10%. Otherwise, just adjust for inflation. The result? Morningstar found that guardrails let retirees spend 38% more over their lifetime compared to the static 3.7% rule. That's going from $37,000 to over $51,000 annually. Another popular strategy is bucketing. Divide your portfolio into 3 buckets. Bucket 1, cash covering 1 to 2 years of expenses. Bucket 2, bonds and dividend stocks covering 5 to 7 years. Bucket 3, growth stocks for the long term. When the market crashes, you're not panicking because you're drawing from cash and bonds, not stocks. By the time you need to refill those buckets, the market has usually recovered. This eliminates sequence risk early in retirement, allowing 4% to 4.5% withdrawal rates safely. Finally, partial annuitization. Take 20% to 30% of your portfolio and buy an immediate annuity for guaranteed income covering essential expenses. Then, take more risk with the rest. Research shows this modest annuitization significantly improves retirement outcomes by creating an income floor. Let's make this practical. Here's how to build a withdrawal plan that works for you. Step 1. Know your number. Calculate your annual expenses honestly. Include everything: housing, food, healthcare, travel, hobbies. Add a 10% to 20% cushion for unexpected costs. Step 2. Factor in other income. Subtract Social Security, pensions, or rental income from your expense number. What's left is what you need from your portfolio. If you need $60,000 a year and get $20,000 from Social Security, you need $40,000 from your portfolio. Step 3. Calculate your withdrawal rate. Divide your portfolio need by your total savings. $40,000 needed divided by 1 million saved equals 4%. Compare this to current research. If you're above 4.5% and unwilling to be flexible, you may need to adjust spending or delay retirement. Step 4. Choose your strategy. Want fixed withdrawals with maximum safety? Go with 3.7%. Want flexibility and higher income? Use guardrails at 4% to 4.5%. Want psychological comfort from market crashes? Use bucketing. Step 5. Plan for taxes. This is huge. Traditional IRA withdrawals are taxed as income. If you're in the 22% bracket, you need to withdraw $51,000 to have $40,000 after taxes. Roth IRA withdrawals are tax-free. Taxable account sales incur capital gains tax, usually 15%. Smart sequence. Start with required minimum distributions at age 73. Then pull extra from traditional IRAs to fill your tax bracket. Next, tap taxable accounts using losses to offset gains. Save Roth for last. It's most tax efficient and should grow longest. Step 6. Review annually. Every year, recalculate. Look at your balance, your withdrawal rate, and market conditions. If your portfolio grew, maybe increase spending. If it dropped, tighten for a year or two. This annual review keeps you on track for 30+ years. Let me show you how this works in real life with 3 quick examples. Conservative Carla is 65 with $750,000 and no pension. She wants $30,000 a year and values predictability. Her solution, take $300,000 and buy an immediate annuity paying $18,000 a year for life. The remaining $450,000 stays in a conservative portfolio withdrawing 3% annually, another $13,500. Total, $31,500 with maximum safety. Balanced Brian is 65 with $1.2 million, a $10,000 pension, and plans to claim Social Security at 70. He wants $50,000 a year and is willing to be flexible. His approach, start with a 4% withdrawal using Guardrails. That's $48,000 from his portfolio plus $10,000 from his pension. He adjusts spending up or down by 10% based on market performance. When Social Security kicks in at 70, he'll only need $25,000 from his portfolio, a 2% rate. He's set for life. Flexible Fiona is 62 with $2 million and wants $80,000 a year. Her strategy, build a dividend-focused portfolio yielding 3% annually. That's $60,000 in dividends and interest without selling shares. For the extra $20,000, she uses flexible withdrawals, taking less in down years and more in good years. This preserves her portfolio while maximizing lifetime income. Before we wrap up, I should mention there are a few other strategies out there, like CAPE, that is cyclically adjusted, price-to-earnings ratio-based withdrawal rules, age-adjusted formulas, and RMD, that is required minimum distribution. Like approaches. These can work well for certain situations, but they're a bit more technical and require either comfortable number crunching or professional guidance. If you're interested in exploring these more advanced strategies, I'd recommend sitting down with a fee-only financial planner who can run the numbers specific to your situation. Sometimes having an expert walk you through the details makes all the difference. Okay, let's bring this home. The 4% rule isn't dead, but it's definitely not what it used to be. If you're planning to retire in the next few years, you need to understand that starting with a rigid 4% withdrawal might be riskier than it was for previous generations. The good news? You have better tools now. Here are your 3 big takeaways. 1. If you want maximum safety and you're not willing to adjust your spending, start with 3.7%. It's not as fun as 4%, but it's based on current market conditions and gives you a 90% success rate. 2. If you're willing to be flexible, spending a little less in bad years and a little more in good years, you can start higher, often 4.5% to 5%, using strategies like guardrails or bucketing. And 3. Taxes matter a lot. The order in which you withdraw from different accounts can save you thousands of dollars every year. The most important thing I want you to remember is this: retirement planning isn't about following a rigid rule. It's about understanding your needs, your risk tolerance, and your flexibility. It's about building a plan that fits your life. And it's about reviewing that plan every year and making adjustments when needed. If this video helped you, do me a favor. Hit that like button and subscribe to Simple Money Method. We're building a community of people who want to make smarter financial decisions without the jargon and without the fear. Drop a comment below and let me know. Are you planning to use the traditional 4% rule? Or are you going with something more flexible? I read every single comment and I'd love to hear your thoughts. Thanks for watching, and I'll see you in the next one.